and welcome to the Property Wealth Podcast. It's great to have you with us for another insightful episode.
Absolutely, Sarah. It's always a pleasure to share our thoughts with our listeners.
Today, we're diving into a topic that's been on a lot of people's minds lately. Real estate in a recession, specifically what we might expect in 2026.
Right, it's a crucial conversation, especially for those of us over 40 who are looking to build long-term wealth through property investment.
Yeah, and a lot of folks might feel a bit anxious about investing during uncertain times, but we're here to unpack that and provide some practical insights.
Exactly. We'll talk about the potential opportunities that can arise even in a recession, how to approach your investment strategy, and what to consider before making any decisions.
Plus, we'll also touch on how market cycles work, the importance of location, and maybe even some tips on how to navigate financing in a downturn.
That's right. There's always a way forward. And understanding the landscape can really help you make informed choices.
So let's get started. Where do you think we should kick things off, Mike?
So, Sarah, when we talk about real estate investing, especially in a recessionary environment like we're anticipating in 2026, it really hits home for those of us over 40.
Absolutely, Mike. It's like this stage in life, retirement isn't just a vague idea anymore, right? It's becoming a reality.
Exactly. And with inflation creeping up, the value of our savings can diminish pretty quickly. Real estate, though, has always been a solid hedge against inflation.
Yeah, it's like a fortress for your money. I've heard stories from investors who bought properties during tough economic times and ended up doing really well.
Right. Take, for instance, a client of mine, let's call him Tom. He bought a rental property back in 2008, right when the market was crashing. Everyone was scared, but he saw the potential.
That's brave. What happened to him?
Well, fast forward to today, that property has appreciated significantly, and he's been able to use the cash flow to fund his retirement. And it's not just about the money. It's the peace of mind,
Oh, definitely. It's like knowing he's got that income coming in makes him feel secure.
Exactly. And for many people over 40, that emotional side of financial security is huge. It's not just about having enough money. It's about feeling stable and prepared for whatever life throws our way.
And then there's the whole idea of wealth transfer.
Right. A lot of folks in their 40s and 50s are thinking about how they can pass on wealth to their kids or grandkids. Real estate is a tangible asset that can be handed down.
It's something they can see and touch, Unlike stocks or bonds that can feel a bit abstract.
Exactly. Plus, real estate can provide an ongoing income for those heirs, which is a nice safety net.
I remember hearing about a couple, let's call them Mary and John, who bought a duplex in their 50s. They lived in one unit and rented out the other.
That's a smart move.
Right? They used the rental income to pay down the mortgage faster, and now they're nearing retirement. Their plan is to keep that property and pass it on to their kids.
And imagine the impact that has on their children's financial futures. That's a legacy built on smart decisions.
That's exactly it. So with these current economic trends, why is it particularly important for our listeners to start thinking about real estate now?
Well, the market is always shifting, and with potential recession looming, there's often less competition. You can find better deals if you're willing to look.
Yeah, and with interest rates fluctuating, timing can be everything.
Right, so if you're over 40, this is your time to act. You're not just investing for yourself, but also for your family's future.
That's so true. I think a lot of people feel paralyzed by fear or uncertainty, especially in a recession.
Exactly. But remember, real estate is a long-term game. It's about weathering the storms.
And it can be a really rewarding journey if you approach it with the right mindset.
Absolutely. Plus, if you're able to secure a good property now, you're setting yourself up for success later, when the market rebounds.
It's like planting a tree. The best time was years ago, but the second best time is now.
Well said. And let's not forget how important it is to stay educated and informed about market trends.
Yes, knowledge is power. If you know what's happening, you can make better decisions.
And I think for those over 40, it's also about adapting to change. You might need to pivot your strategy as the market shifts, but that flexibility can lead to opportunities.
Right. I mean, if you're used to traditional investments, stepping into real estate might feel daunting.
It can be, but it's also incredibly liberating. Imagine finding a property that not only generates income, but also appreciates over time.
And it's not just about the numbers, is it? It's about creating a lifestyle, building a community.
Exactly. It's about finding a place that resonates with you and your family, a place where memories are made.
And then there's the emotional reward of knowing you're building something tangible for your loved ones.
Yes, the emotional aspect can't be overstated. It provides a sense of purpose and direction, especially as we think about retirement.
So if someone is sitting there feeling uncertain about their financial future and how real estate fits in, what would you advise?
I'd say start small. Look for opportunities that feel right for you. Consider your goals, your timeline, and your comfort level.
And don't be afraid to seek advice or get a mentor.
That's key. Connecting with someone who's been through it can really help you navigate the waters.
So it's all about taking those first steps, isn't it?
Absolutely. And remember, every little step counts in the journey to financial security and building wealth through real estate.
Well, that's a great lead-in to the core strategies we'll be discussing next.
So when we're looking at investing during a recession, it's really important to have some solid strategies in place. One of the first things I always mention is the 1% rule.
Right, the 1% rule? Can you break that down a bit for our listeners?
Absolutely. The 1% rule basically says that the monthly rent you can charge should be about 1% of the purchase price of the property. So if you buy a property for $200,000, you should aim to rent it for about $2,000 a month.
That makes sense. It's a quick way to gauge if a property is a good investment, right?
Exactly. But it's not the only thing to consider. You want to also think about your expenses, like maintenance, property management fees, and vacancy rates.
So would it be safe to say that the 1% rule is more like a starting point?
Yes, definitely. It's a guideline, not a hard and fast rule. You might find properties that don't quite meet that 1%, but still could be great investments, especially if they're in a high-demand area.
Got it. And what about the 50% rule? I've heard that one tossed around a bit, too.
The 50% rule is another useful benchmark. It suggests that you should expect around 50% of your rental income to go towards expenses. So if you're bringing in $2,000 a month in rent, you'd budget about $1,000 for expenses, which includes everything from property taxes to repairs.
That's a helpful way to think about cash flow, for sure.
Right? And when you're evaluating a deal, you can use both rules together. For example, if a property meets the 1% rule, but you find that your expenses are going to be more than 50% of the income, then it might not be worth it.
So it's about balancing those two rules.
Precisely. And then there's the cap rate, which is another important metric. The capitalization rate gives you a sense of the return on your investment based on the net operating income.
How do you calculate that?
Well, it's pretty straightforward. You take the net operating income, which is your rental income, minus your operating expenses, and then divide that by the property's purchase price.
So if a property has a net operating income of $20,000 and you bought it for $200,000, your cap rate would be...
That would be 10%. You just do $20,000 divided by $200,000.
That's a solid return. But what's a good cap rate to aim for?
Generally, you want to see a cap rate of at least 8% to consider it a worthwhile investment, but it can vary depending on the market. In some areas, anything above 6% might be considered good.
So it's really about understanding the market you're in, huh?
Exactly. And when you're doing your due diligence, having a checklist can really help streamline the process. I usually recommend creating a deal evaluation checklist that includes these metrics.
What kind of items would you put on that checklist?
Well, start with the basics. You want to check the property location, condition, potential rental income, and any repairs needed. Then move on to financial metrics like the 1% rule, the 50% rule, and the cap rate.
That's a solid foundation.
Yeah, and don't forget about financing options. You'll want to know what types of loans are available to you.
Right, and especially in a recession, lenders might tighten up their criteria.
Exactly. It's crucial to have a good understanding of your credit score, debt-to-income ratio, and the different types of mortgages out there. You might consider conventional loans, FHA loans, or even private money lenders, if traditional options aren't available.
What about the types of properties to focus on during a recession? Any recommendations?
Generally, I'd suggest looking at multifamily properties. They tend to perform better in downturns because, more people tend to rent during tough economic times.
That's a great point. More renters means more demand, right?
Exactly. Plus, look for properties in stable neighborhoods with good schools or access to public transport. Those tend to hold their value better during economic downturns.
So it's about finding that balance between rental demand and long-term stability.
That's right. And remember, even if you find a property that checks all the boxes, you want to take the time to analyze the local market trends. Is it growing or is it stagnant?
That sounds like something that could make or break your investment.
For sure. And as we transition to discussing common pitfalls, it's worth noting that one of the biggest mistakes investors make is failing to do their homework.
Yeah, it's easy to get excited about a property and skip the nitty-gritty details, but those details can really save you in the long run.
Exactly. You've got to stay diligent and informed. It's those small oversights that can lead to significant issues down the road.
Let's dive deeper into those pitfalls next.
Sarah, one of the biggest pitfalls I see with investors, especially those just starting out, is over-leveraging. It's tempting, right? You get excited about that next property and think, if I just borrow a little more, I can get this amazing deal.
Absolutely, and it often feels like a safe bet when the market's going up. But when the market shifts, that kind of leverage can really bite you.
Exactly. I remember a client of mine, let's call him John. He bought a couple of properties with very little down, thinking he could flip them quickly and make a profit. But then, the market cooled down. He found himself with 2 properties that were costing him money instead of making it.
Ouch. That's a tough lesson to learn. It's like they're holding on to these properties, hoping the value will go back up. But the cash flow just isn't there.
Right. And the problem is, while they're waiting, they're still stuck with mortgage payments, taxes, maintenance, all those hidden costs that can really add up.
Speaking of hidden costs, that reminds me of another common mistake: ignoring cash flow.
Absolutely. It seems basic, but I can't tell you how many people overlook it. They get so caught up in the potential appreciation, they forget about the monthly expenses.
Yeah, like that story you told me about, Lisa. She bought that rental property thinking it was a steal, but didn't factor in the ongoing expenses, right?
Yes. Lisa had purchased a place in a neighborhood that seemed promising, but then the repairs started piling up. The roof needed work, and the plumbing was a nightmare. She was left with a property that was draining her financially instead of being a source of income.
It's so easy to fall into that trap. And then there are bad tenants.
Oh, absolutely. Bad tenants can be a real headache. They can cause damage, missed payments, or even just be a nuisance.
I remember you mentioning that investor, Tom, who had a particularly challenging experience.
Right. Tom thought he found a great tenant who seemed perfect on paper. But once he moved in, it became clear he had issues, like consistently paying late and creating disturbances. Tom ended up spending more time and money trying to evict him than he ever anticipated.
That's a nightmare. I mean, how can investors better screen tenants to avoid situations like that?
Well, I always recommend a thorough screening process. Background checks, credit checks, and, if possible, speaking to previous landlords. It's about getting a full picture of who you're renting to.
Good advice. Now, let's talk about timing the market. That's another common mistake.
Yes. Investors often wait for the perfect moment to buy, thinking they can time the market. In reality, that's a gamble.
Right. You can miss out on some great opportunities while you're waiting for the market to dip.
Exactly. I had a client, let's call her Emily. She hesitated to buy when she saw a property that fit all her criteria. She waited for a dip that never came.
So she lost out completely?
Yes, and when she finally decided to jump in, prices had escalated significantly. She ended up paying a lot more than if she had acted sooner.
That's a tough lesson. It really emphasizes the need to do your research and understand your own financial situation, rather than trying to predict market movements.
Totally. And then, of course, there are the hidden costs that can sneak up on you.
Like what?
Well, aside from the repairs and maintenance we mentioned, there are costs like property management fees, insurance, and sometimes even association fees.
Right. And those can really eat into your profits.
Exactly. I had a friend who bought a condo. He was thrilled with the price, but then he discovered the association fees were sky high. It cut into his cash flow dramatically.
That's frustrating. It's crucial to look at the total picture before making a decision.
Definitely, it's about understanding the total cost of ownership, not just the purchase price.
So how can someone spot these red flags early on?
Well, I think it starts with education. You have to familiarize yourself with the market and the property types you're interested in. Look at historical trends, talk to other investors, and maybe even join a local real estate group.
Networking can be so valuable. Plus, it's a great way to learn from others. Mistakes.
Exactly. And having a good team in place is crucial too, like a reliable real estate agent, a good property manager, and a fantastic accountant. They can help guide you through the process and point out potential pitfalls.
That's solid advice, Mike. So if someone finds themselves in a tough spot due to some of these common mistakes, what's the best way to recover?
First, take a step back and reassess your situation. Understand where you stand financially and what your options are. Sometimes, it may mean holding onto a property longer than you'd like. But if you can ride out the storm, you might come out okay on the other side.
And sometimes, selling might be the best option, right?
Absolutely. If a property is draining your resources and you can't see a path to recovery, it might be time to cut your losses.
It's all about making informed decisions based on your current situation and future goals, isn't it?
Exactly. Being proactive and informed can help you avoid these pitfalls in the first place, or at least mitigate their impact if they do happen.
Well, that's a lot of valuable information to consider. I think it really highlights the importance of being educated and prepared in this market.
Definitely. And the more you learn, the better equipped you'll be to navigate whatever comes your way.
So what are the next steps for someone looking to get started or improve their current investment strategy?
Well, I'd say start by doing your homework. Research the market, understand your financial position, and perhaps even connect with a mentor in real estate.
Sounds like a solid plan. Thanks for sharing all this insight, Mike.
My pleasure, Sarah. I hope it helps some listeners out there. All right, so let's talk about some immediate steps people can take right now, to get started in real estate, especially with this recession outlook in mind.
Yeah, absolutely. I think the first thing is really about getting educated, right? There are some fantastic resources out there.
For sure. One tool I always recommend is Zillow. It's not just for browsing properties, but you can also get a sense of market trends, pricing, and even rental estimates.
Right. And speaking of rental estimates, Rentometer is another great tool. It helps you see what similar properties in a specific area are renting for. That's crucial if you're considering investment properties.
Exactly. And if you're more into analyzing deals, the Bigger Pockets calculator is fantastic. It helps you crunch the numbers on potential cash flow, ROI, and all those important metrics.
Oh, I love that one. It really helps demystify the financial side of things. And for those who are looking to analyze deals on the go, DealCheck is a great app. You can evaluate properties quickly, which is super handy.
And don't forget the local MLS access. If you can get access to your local multiple listing service, that's invaluable. You can see properties as soon as they hit the market, which can give you a huge advantage.
Yeah, timing is everything in this game. So what about habits? What are some small, actionable habits people can start with?
Well, for starters, I'd suggest analyzing just one deal per week. It doesn't have to be complicated. Just pick a property, run the numbers, and see if it makes sense.
That's a great idea. And it keeps you in the habit of looking at real estate regularly. What about joining local meetups?
Absolutely. Networking can be a game changer. You meet other investors, share experiences, and learn from one another. Plus, it's a great way to find potential partners or even mentors.
Right. And there are so many online communities too. Bigger Pockets has forums where you can connect with others, ask questions, and get advice. It's like having a support system at your fingertips.
And don't underestimate the power of listening to podcasts or reading books. There are some really insightful ones out there. For example, the book on rental property investing by Brandon Turner is a classic.
Oh, I've heard great things about that one. And there's also Real Estate Investing for Dummies if you're looking for something that breaks it down really simply.
Yeah, it's all about finding resources that resonate with you. And remember, you don't have to know everything at once. Just start where you are.
Exactly. It's about progress, not perfection. People can also set small goals, like reading one chapter a week or listening to one podcast episode.
Right, and track your progress. Keeping a journal or a spreadsheet can help you see how far you've come.
That's a fantastic idea. It adds a layer of accountability, which can really motivate you.
And if you're feeling a bit lost, consider finding a mentor or a coach. Having someone who's been through the trenches can provide you with guidance tailored to your specific situation.
I love that. It can make such a difference to have that personalized support.
Yeah, and don't forget about the importance of staying informed about the market. Subscribe to local real estate newsletters, follow market reports, and keep an eye on economic indicators.
That's a good point, Mike. Knowledge really is power in this game.
And as you gather information and tools, you'll start to feel more confident in your decisions.
Definitely. So with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
Well, as we wrap up this episode, let's quickly summarize some of the key takeaways from our discussion on Real Estate in a Recession 2026 Outlook.
Yeah, absolutely. First off, we talked about the importance of understanding local markets and how they can behave differently during a recession, right?
Exactly. Knowing where to look for opportunities can be a game changer. Even in tough times, some areas might still be thriving.
And then we touched on the concept of cash flow. It's crucial to have properties that generate consistent income, especially when economic uncertainty looms.
Right. And we also mentioned the value of diversifying your portfolio. Having a mix of property types can help mitigate risks.
Oh, and let's not forget about the long-term perspective. Real estate is typically a slow and steady game, so patience really pays off.
Absolutely. It's about building wealth over time, not just quick wins.
Speaking of building wealth, for anyone listening, remember that real estate can be a powerful tool to secure your financial future.
Totally. It's a journey, but one worth taking if you stay informed and strategic.
If you found today's episode insightful, please give us a like, subscribe, and drop a comment sharing your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone over 40 who's looking to dive into property investing. They might just find the motivation they need.
Next time, we'll be diving into a really interesting topic, buying in declining markets. It's a contrarian play that might surprise you.
Yeah, you won't want to miss that.
Thanks for joining us today.
Until next time, happy investing.
Take care, everyone.